That's what you want in your network. Each one teach one. And that's how these very successful funds are organized, in these teams where everyone has a different specialty. Everyone's learning from everyone else. One thing I was sharing last night at the dinner event, look at every high performance field. It could be the performing arts. It could be professional athletics. It could be professional chess. Look at every high performance field, and what do you find? Two things. One is the presence of mentoring. Think about it. Does a person just practicing on their own become an NBA basketball star? No, I don't think so. Or do they become a world famous opera talent just singing into a microphone themselves? No. There's always mentoring, there's always coaching. To develop ourselves in an elite way, we need to learn from people who are doing elite things. And so that becomes very important. The second thing, and I'll be talking about this a little bit later on, is that think about every performance field, and you will find a mathematical relationship. In every performance field, developing talent involves spending more time in practice and learning than in actual performing. Think about how much time is spent on a football field practicing plays, or on a basketball court. How much time is spent in rehearsals for a Broadway play. A big, big, big reason that traders don't succeed is that, what do they want to do? They want to trade. They want to make money. And so they don't do the practice. It'd be like, hey, I want to be an NBA star, so I'm going to go right on the floor. And that didn't work for me, by the way. So you want to be in a setting where you are immersed with talent, with mentors, and where you have the opportunity to practice, 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 learn, 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 and then eventually you grow your talent. And that's when you start putting good money at risk. You don't just start out trading big amounts and getting frustrated. That's a great way to ruin your trading psychology. Okay, a few other broad points before we get into the meat of the presentation, and I will leave time for questions as well. A key to success, and I'm going to say something that some of you may disagree with, because a lot of times, especially with short-term traders, where I started in Chicago, the average holding time was 6 minutes. Okay, so especially with short-term traders, what do they look for to figure out what to buy, what to sell? They look for a setup, right? So how is this market setting up? And they're looking at charts, and they're looking at maybe also at news information or different catalysts. I think that's the wrong place to start. I think that's necessary for success, not sufficient. Your edge begins, and this is one of the most important points I'll touch upon. Your edge begins by knowing, really knowing, who you are making money from. Because you are exploiting the behavioral tendencies and the trading tendencies of some other players in the market. And the big problem for developing traders is they don't know who they're making money from because they haven't worked at investment banks, they haven't worked at hedge funds, they haven't worked at different kinds of proprietary trading firms, et cetera, et cetera, et cetera. I use a lot of basketball analogies. I went to Duke. It'd be like if you were in a basketball tournament and you didn't know who your opponent was, or you didn't study your opponent. How in the world are you going to effectively prepare for that game? So you want to know who you're going to make money from. Now, who do you think you're making money from? Any guesses? What's that? Other retail traders? Gamblers? Okay. No, the correct answer is you're making money from me, because I really suck. No. You wouldn't be making much money in that case. I am going to argue that increasingly over the last number of years, certainly the last 5 years or so, you have the opportunity to make money from hedge fund participants. Hedge fund participants are experienced. They're not retail rookies. But what has happened in the hedge fund world is that it has expanded tremendously. You now have these quote-unquote multi-strat funds, multi-strategy, that are truly global in their membership, and they are managing increasing amounts of capital. So it's not at all unusual for me to work with a fund that has 20 billion in capital, 30 billion in capital, 40 billion in capital, and so forth. And the smallest trading account for a beginner, for someone they just hire, is 200 million. And there are more and more and more of these funds that have started up literally all around the world. So you have crowding. You have more people chasing pretty much the same markets. Now, in addition to that, the people who fund these businesses have become more tight in their risk tolerance. When I first started at a macro hedge fund, the allowable drawdown was 20% before you would be kicked out, before you had to stop trading. Now it's not unusual for that number to be closer to 5%, to 10%. So you have more and more and more people trading, and you have tighter and tighter and tighter risk controls. And what do you think that does? Churning. Yeah, that's a good way of putting it. You have people who need to make money, and so they get into positions, and the positions start to go against them. What do? They have to get out. They can't afford to lose the money. And you have crowding, people in crowds, and they're all short fixed income, and it's not working out, and so they all have to exit the positions, and then rinse and repeat. So lots of crowding, lots of unwinding, lots of crowding, lots of chasing opportunities, lots of unwinding of opportunities. And for someone who has short-term trading skills and knows how to read markets, you can be quicker than that herd. And you can catch those opportunities where the crowd's getting in, the crowd's getting out. So I would argue that you have potentially an underappreciated opportunity to take advantage of who is in the market and how they behave. Now, what that means is that you have to think like they think. And they don't get into trades just based on quote-unquote setups. What gets them into a trade is an idea, something they've researched, something about central bank policy, something about economic performance, maybe a catalyst from geopolitical conflict. They have some idea about what's going to move the market, and then they translate their idea into a trade. And it's when they are ready to make that translation from idea to trade, that's when they look at the setup. That's when they look at the chart. That's where they figure, where do I get good risk reward? But you want to know what ideas are people chasing, because that will give you a good idea of where the crowd is running. The number one idea that people have been chasing unsuccessfully so far in the past year has been the anticipation of weaker economy, even recession, and the Federal Reserve and other central banks cutting interest rates. So the hedge funds in the market have been very focused on rates, have been very focused on bonds and short-term interest rates. The yield curve inverted last year. That means short-term interest rates are higher than longer-term interest rates. The 2-year interest rate is higher than the 10-year rate. And historically, what does that lead to? Recession within a year. And so far, no, we have not had recession. And so a lot of people have been stuck in that trade. But what that has also meant is, because that has been a primary focus, they haven't been actively participating in other markets. The people who have been making money have been looking elsewhere. Commodities have been hot. Look at oil, look at copper. What else has been hot? I think stocks. At least some of them, okay? So many times, by knowing what the crowd is focusing on, you can find opportunity in the less crowded areas. And I'm happy to be in touch with the group to share whatever I observe as far as where crowds are and where opportunities may be. So if we go to the slide, I titled this The Positive Psychology of Trading. Positive psychology is a trend within the field of psychology which looks at our positive qualities, our strengths, and our competencies. And the idea is that we get better, better, better. We develop expertise not just by correcting our problems, but by building on the best of who we are. So that's why it's called the positive psychology of trading. So why the big picture matters? The largest players trade the biggest pictures. So you want to know, big picture, where's money flowing to, where's money flowing from? Volume is very important in terms of telling you who is in the market. That's why tracking RVOL is so important in your trading. If you see a market move and the relative volume is really increasing, that means the volume for that time of day is really increasing, what's that telling you? New additional participants are in that market, are in that trade. Who are they? If you see big volume coming into a stock you're trading, the big volume is not a bunch of individual traders at home in their underwear trading 3 lots. No! It's a footprint of the larger participants of the market. So you can track with volume, with relative volume, who's in the market, what they're doing. So you get a breakout move, or you get a move on a catalyst. You know how we talk about breaking news trading. You get a catalyst, and you get big volume coming in, some big players are participating. Another aspect of the big picture that a lot of people don't appreciate is you have trending momentum markets, so markets that are moving in a particular direction. And what's the opposite of a trending momentum market? Yeah, what a lot of people will say is a choppy market. And what they mean by choppy is that it's unfucking tradable. That's a technical psychological term. So if they don't see a trend, if they don't see Momo, they think there's no trade to be had. Wrong, 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 wrong. Many, 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 many times, the alternative to a trending market is a rotational market. In other words, the amount of money from institutions in the market is not decreasing, but it's being reallocated. So you're seeing money going into growth stocks and away from value stocks. You're seeing money going into consumer discretionary shares away from consumer staples. So money is rotating from one sector to another sector, one part of the market to another part of the market. Money is rotating from big cap stocks away from small cap. These are all rotations. And by tracking relative strength, how one sector is behaving versus another sector, we can track how relative strength is trending. The trend is not in the overall market. The overall market might be trading in a range. But in terms of the relative play, there's a trend there. But people don't look at it. You want to think in relative terms, not only absolute directional terms. Lots and lots of opportunity there. And I would argue that in the current equity market, in the current stock market, we're seeing rotation, even though the market's been going up, 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 and we've been making new highs. Certain things have been quite strong. You probably haven't noticed the technology names. And I mentioned this to a group yesterday over dinner. What's not making new highs? What sectors are relatively weak? Regional banks, real estate. Look at ETFs and look at funds that are just in commercial real estate. They're underperforming considerably. Now, in a raging bull market, if you have sectors that can't make new highs, even in that environment, that's telling you something. As a rule, patterns of relative strength and weakness tend to precede patterns of absolute strength or weakness. So it'll be interesting to see going forward what happens with the regional banks that are funding commercial real estate in particular. We get spending, spending, spending. We suddenly get the spending translating into inflation, the inflation translating into higher rates, the higher rates hurting the commercial real estate further, hurting the regional banks further. So we may be setting up, not immediately, not tomorrow, not next week, not next month, but we may be setting up with some themes by looking in relative terms. And conversely, when the market's weak and certain sectors can't make new lows, that's real information. I've written quite a bit about the role of creativity in trading. The ability to see new things, the ability to see things differently from other people. When we process multiple markets, when we process different inputs to different markets, when we have an open mind to seeing new and different things, That's what helps us generate promising ideas. It's a creativity process. One of the patterns that's been most reliable in my experience and in my own trading is identifying opportunities or occasions where you have buying pressure, buying pressure, buying pressure, but you can't make new highs. Or selling pressure, selling pressure, selling pressure, and you can't make new lows. So one of the indicators I've talked about is the NYSE tick, T-I-C-K. That's the number of stocks upticking versus downticking. And that's out there for the NYSE like 20 times each minute. And so you can identify when stocks are ticking up, stocks are ticking up, and stocks are ticking up. But the overall index isn't going higher, and vice versa. Back in Chicago, we looked at every single transaction, every trade in every stock, and is that trade occurring nearer to the bid price or nearer to the offer price? If people are transacting and lifting offers, it tells you there's buying interest. If they're transacting and they're hitting bids, it tells you they want to get out. And so you can get these patterns where they're hitting bids and hitting bids and hitting bids, and we don't make new lows. All those people hitting bids, they are shorts that are going to become trapped. And you can make money when it turns around. That's a reliable pattern. But you need to process markets differently and uniquely to find those kind of opportunities. Barbara Fredrickson, psychologist, talks about broaden and build. That when we are in an open-minded mindset, when we're in a positive mindset, we tend to see more of the world. Our perception is broader, and we can build upon the breadth of those things that we see. The really successful traders I work with just look at more things. And then they have the ability to look at more things in different ways. So they're playing in a vastly expanded universe. When I first, Mike was mentioning, when I first worked at SMB, 2007, when I first started working with Kenny Shark, what do you think the first thing I noticed was? You have a guess, Mike?
So many things. His hair?
How is his desk different from the desks of the other people?
More screens.
Hugely more screens. He had so many screens open. He's looking at different things and this and this and this and this, and he could quickly point out. He had that speed of processing, and he had that ability to see different things in different ways, and he just had more opportunity as a result of that. So in terms of what I've observed at hedge funds, but also elsewhere, a key to success is identifying and maximizing your strengths. Many times people keep a journal, and what do they write in their journal? Basically, it's how I shit the bed. Another technical psychological term. They write down all their problems, everything they did wrong, when it's just as important to learn from your successes. What did I do today? What did I do this week that was really good? And once I identify what I did really well, how can I do that again? How can I do that again? How can I build upon that? Strengthen teams. Teaming up with people who have strengths that are different from yours. so that you can learn from them, they can learn from you. The best teams are multi-specialty, so to speak. They look at different things, process information different ways, and they learn from and with each other. And finally, there's research on what's called the flow state. We concentrate, we focus so much that we get into the flow. We lose sense of time, and we become absorbed in what we're doing. And the research suggests that flow enhances creativity, that we best see new things and different things when we're in a state of high focus. So we want to be looking at different things in different ways with different people in a focused way. So, in terms of positive psychology, 4 big dimensions. Happiness, doing things that we like doing, that we enjoy. Fulfillment, doing things that are meaningful to us. Energy, doing things that give us energy. And affection, being close to people who are important to us. What the research on performance tells us is that we are going to perform better. We're going to be able to broaden and build and be more creative when we are firing on all 4 cylinders. So you want this to become a kind of checklist for you. What are you doing each day, each week to make yourself happy, to bring yourself fulfillment, to give yourself energy, and to be close to the people that matter to you? There's a common perception that if you're going to be successful in trading, you have to focus on trading, and have such a passion for trading, that's all you care about. Bullshit. That's called an unbalanced life. And eventually, your psychology rides up and down with your P&L. You want to have many sources of happiness, fulfillment, energy, and affection that gives you energy, that gives you focus, and helps your trading. Big, big, big idea from positive psychology. Many challenges we face result from the absence of positive experience, not the presence of conflicts and deficits. If we're having problems in our trading, it's not necessarily that we have no control over our emotions or we have some inner block toward being successful. Many times it's the absence of the positives in our lives that makes it difficult to really focus and sustain focus in the markets. I know we're moving on in time. I'll just mention a couple other ideas because I do want to leave a little time for questions. Think of trading not as a process, but as multiple processes. It starts with generating an idea, and that's where